Okay, welcome to the last in this series of videos looking at a country's balance of payments. We're going to focus on current account surplus countries now. So what do we mean by a current account or external surplus? Well, what it means is that there's a net injection of income into a country's circular flow. Surplus countries, oftentimes highly successful export nations, they're known as creditor countries. They're running an external surplus on their balance of payments on the current account. And basically what that means is there's a net inflow of money coming in either from trading goods and services or from net inflows of primary and secondary income. If you're running a current account surplus, that will lead to an accumulation of foreign exchange. Could be in dollars, could be in euros, who knows. That comes from selling exports of goods and services, or it comes from an inflow of primary and secondary income. In previous videos, we've tended to focus more on countries running a current account deficit. So I think it's good to just redress the balance a little bit and think about surplus countries. And here's the data for the countries in the world with some of the biggest surpluses in 2018 and 2019. The data here is expressed not in dollars or pounds, but as a percentage share of a country's GDP. And you can see that Kuwait, Singapore, Macau, Switzerland, Germany, Thailand, a lot of these countries are running substantial current account surpluses. Singapore is interesting. They run a current account surplus of more than 17% of GDP in each of the last 2 years. Netherlands is a big surplus country. So too Germany, probably the biggest current account surplus in the world, I guess. Norway, South Korea, Japan. Thailand runs a big current account surplus in excess of 7% of their GDP. I've put at the bottom there China, and a lot of people focus on China as a big exporting machine. Their current account surplus measured as a percentage of their GDP, well, it is a surplus, but as you can see, it's fairly small as a share of GDP. It's about 1%. So what are the main causes, the main underlying causes of a current account surplus? Why are some countries external creditor nations? Well, sometimes it's because of success. They have built scaled, successful export businesses and industries across the world. Oftentimes they have globally successful businesses, tapping in successfully to fast-growing markets, and they are strong net exporters, often of goods, perhaps of services as well. So sometimes it comes from just pure export success. Perhaps they're exporting too much, but who knows? Second key cause of an external surplus is a country typically has a high rate of savings over investments. It could be the case there's a lot of corporate savings or household savings, which means they're not necessarily spending much on imported goods. And you can make a case for saying that some of these surplus countries perhaps could be spending more on imports to help redress trade imbalances. Oftentimes, an export or trade surplus is the consequence of very high world prices for their key exports. So, for example, Australia could run a current account surplus because the world price of iron ore is very high, or the world price of liquefied natural gas. And don't forget, we're talking here about current account, not just trade. So a current account surplus might result from a country enjoying a very strong net inflow of investment income from assets, businesses, investments overseas, or when there are big inflows of remittances from people living and working in other countries. I suspect Thailand is probably a good example of that. It's a hugely successful country in terms of travel and tourism, but many Thais live overseas, and there's a strong inflow of remittances into their economy, which boosts their current account. What about the macroeconomic impact or effects of a current account surplus? Well, crucially, if you're running an external surplus on your current account, that really allows a country to run a deficit on the financial account, on the balance of payments. You see, if you're an external creditor, that effectively allows you to lend to other countries. Surplus foreign currency that you've built up in dollars and euros and pounds, well, that money can be used to fund investment in assets located overseas. Indeed, many of those surplus countries, Norway, China, they have built up large sovereign wealth funds, which hundreds of billions of dollars, which are invested overseas. So one macro effect is that obviously there's a net injection into your circular flow, but it does mean that you can invest overseas. Equally, what the money coming in to a country, the money flowing into a nation if you're running an external surplus, may cause your exchange rate to appreciate. If you're successfully exporting goods and services, there's a stronger demand for your currency, and if the demand for currency goes up, other things being the same, the currency could appreciate. So there we go, some thoughts on the economics of current account surpluses.